Disclaimer.
Forget the price on the screen. Today, January 20th, silver broke $95, but that's just the tip of the iceberg. While the world is debating Trump's Greenland ultimatum, the real news is elsewhere. The U.S. Mint just set a domestic price for the metal at $173. That is not a forecast. It is an official admission of a shortage. The U.S. has started a resource war over Greenland because there's no more free silver. If you're holding paper contracts, you're trapped. If you're holding physics, your capital has just passed the point of no return. Today, I'll show you why $95 is the last stop before $500. The time for illusions is up. Watch until the end. To learn how to protect your future in the new resource reality. A single White House memo lands on the desks of commodity traders across Wall Street at 6:47 a.m. Eastern Time on what seemed like an ordinary Tuesday morning. The subject line reads, Strategic Arctic Reserves and Resource Sovereignty Protocols. Most people scroll past it while sipping their morning coffee, dismissing it as another bureaucratic document about mineral rights or environmental policy. But 3 minutes later, silver futures explode from $32.80 to $95.40 when pre-market trading, triggering the largest single-day price surge in precious metals history. What just happened? Here's what you need to understand. While cable news networks scramble to discuss the diplomatic implications of Trump's renewed interest in Greenland, something far more significant is unfolding in the commodity markets. The era of cheap silver just ended, not gradually, not with warning signs. It ended in 180 seconds of pure market chaos. Think about this for a moment. You've probably heard about Trump's Greenland comments before. Back in his first term, the media treated it as a quirky real estate fantasy, something to laugh about on late-night comedy shows. But this time, the reaction from the financial markets tells a completely different story. When the President of the United States releases an official memo using phrases like resource sovereignty and strategic national security, the sophisticated money doesn't laugh. It moves, fast. The memo itself contains only 11 pages, but buried in the technical language of Section 7 is a revelation that sent shockwaves through the London Bullion Market Association and the COMEX futures exchanges. The United States government officially recognizes silver as a critical strategic material essential to national defense and economic security in the emerging technological landscape. Those aren't just words, they're a declaration that changes everything about how our country views this metal. What if I told you that major bullion banks had been running naked short positions on silver for years, essentially betting that prices would stay suppressed forever? These weren't small positions. According to data from the Commodity Futures Trading Commission, the concentrated short position in silver futures represented nearly 2 billion ounces of paper contracts, roughly equivalent to 3 years of global mine production. The banks made billions in profits maintaining the system, collecting premiums while physical silver traded far below its true supply and demand equilibrium. But here's where it gets interesting. The moment that White House memo hit the wire services, those banks faced an impossible choice. They could either deliver physical metal to cover their short positions, or they could buy back their paper contracts at whatever price the market demanded. There was just one problem. The physical silver doesn't exist in the quantities they promised to deliver. Pop quiz, what happens when you've sold 3 years' worth of production that hasn't been mined yet? And suddenly the largest economy in the world announces it's entering a resource war where that exact commodity is the primary ammunition. You get forced liquidation, you get margin calls, you get $95 silver before most Americans have finished their breakfast. Let me put this in perspective for you. When silver was trading at $32 last week, you could buy a 1-ounce American Eagle coin for about $38 from most dealers, with that $6 premium covering manufacturing costs and dealer margins. Today, if you try to purchase that same coin, you're looking at prices exceeding $130 in many markets. That's not a typo. While the paper spot price jumped to $95,000, the physical premium exploded to levels we've never witnessed before, creating a nearly $40 gap between what the futures market says silver is worth and what it actually costs to buy the metal and hold it in your hand. This disconnect reveals something crucial about our financial system. For decades, the price of silver was determined not by physical supply and demand, but by paper contracts traded in massive volumes on exchanges in London and New York. Traders could buy and sell millions of ounces without ever touching an actual bar of silver. But when a government steps in and declares a commodity strategically essential, the paper game ends abruptly. According to the sources within the Department of the Interior, the White House memo didn't appear out of nowhere. It represents the culmination of 18 months of classified briefings about America's dependence on foreign suppliers for the materials that power our defense systems, renewable energy infrastructure, and advanced electronics manufacturing. Silver sits at the heart of all three sectors. Your solar panels need it, your military radar systems need it, the servers running our digital economy need it. and we've been importing most of it. Have you noticed how quickly the narrative shifted from Trump wants to buy Greenland to Trump threatens Greenland in the media coverage? That linguistic change matters. A purchase implies negotiation, compromise, mutual benefit. A threat implies unilateral action backed by leverage we're willing to use. The financial markets understood this distinction immediately, even if the general public missed it. Think about this scenario. You're a portfolio manager at a major investment bank. You've been shorting silver for years because it seemed like free money. The industrial demand stays relatively stable, mine production increases slightly each year, and the price stays range-bound between $25 and $35. Your statistical models say it's a safe bet. Then suddenly, the United States government signals it is prepared to use military and economic pressure to secure access to the world's largest untapped silver deposits. What do? You cover your position immediately, at any price, because the alternative is potentially unlimited losses if this metal becomes genuinely scarce. The White House memo specifically mentions ensuring adequate domestic reserves of silver for defense applications and critical infrastructure development through 2035. Federal Reserve data shows that our country currently holds virtually zero strategic silver reserves, unlike gold, which sits in vaults at Fort Knox and the New York Federal Reserve. We depleted our silver stockpile decades ago. Now we're signaling we want it back, and we're looking at Greenland's untapped deposits as the solution. Here's what should grab your attention. The memo doesn't just discuss silver in abstract terms. It identifies specific deposit locations in Greenland's Amazalic region, citing geological surveys that quantify reserves at levels that could supply total global demand for 15 to 20 years. These aren't speculative estimates. These are detailed assessments based on core samples and satellite mineral mapping conducted by teams from the U.S. Geological Survey over the past 2 years. While politicians debate the ethics and legality of resource acquisition strategies, the commodity markets are already pricing in a reality where traditional supply chains no longer function as they did before. The $95 price isn't a bubble or speculation. It's the market's first attempt to value silver in a world where the largest economy has decided this metal is too important to leave in foreign hands. You might be thinking, this will blow over, prices will come back down once the headlines fade, but that's not how resource wars work. Once a government officially classifies something as strategically essential, it doesn't unclassify it when the news cycle moves on. It doubles down. It secures supply. It prevents adversaries from controlling access. The resistance level at $100 per ounce, which technical analysts have discussed for years as an improbable target, now looks quaint. When you reframe silver not as a commodity traded for profit, but as ammunition in a geopolitical contest for industrial supremacy, the old price models become irrelevant. You're not trading silver anymore. You're trading access to the future of technology, energy, and defense. This isn't about real estate or territorial expansion in the traditional sense. It's about our country recognizing that the next industrial age will be won or lost based on access to specific materials, and we've been asleep while other nations secured their supply chains. That White House memo was the wake-up call. The $95 silver price is just the market's initial response to a much larger shift in how we think about resources, sovereignty, and national security. Now let me show you exactly what's sitting under Greenland's frozen surface, because this isn't speculation or political theater. The U.S. Geological Survey released classified findings in November 2025 that were only declassified 3 weeks ago, and the numbers are staggering. The Amazalic region alone contains an estimated 12 billion ounces of high-grade silver deposits, concentrated in formations that are economically viable to extract with current technology. To put that in context, total global mine production last year was barely 800 million ounces. We're talking about 15 years of worldwide supply sitting in one location. But here's what makes those deposits truly extraordinary. The average ore grade in Greenland's primary veins runs between 400 and 600 grams per ton, according to core sample analysis conducted by mining engineers from Colorado School of Mines. Compare that to the largest producing mines in Mexico, where grades have declined to 70 to 90 grams per ton after decades of extraction. You're looking at deposits that are 6 to 8 times richer than what we're currently mining. That's not just valuable, that's transformational. Think about why this matters for you personally. Every solar panel installation that's supposed to power our clean energy future requires between 20 and 30 grams of silver. The average electric vehicle contains between 25 and 50 grams in its electronics and battery management systems. Your smartphone, your laptop, the 5G infrastructure being built across our country right now, all of it depends on silver's unique properties as the most conductive metal on Earth. And we've been dependent on foreign suppliers for nearly 90% of what we consume. The Department of Energy's 2025 Critical Materials Assessment, published last September, identified silver as the single greatest supply chain vulnerability in our transition to renewable energy. The report specifically states that current domestic production capacity cannot support projected demand growth in solar, electric vehicles, and advanced manufacturing sectors beyond 2027 without significant new sources. That's government language for we have a serious problem. What if I told you that the London Bullion Market Association, the institution that set global silver prices for over a century, is currently unable to fulfill physical delivery requests at the quoted spot price? According to sources within major European refineries, delivery delays have extended from the standard 48 hours to 6 to 8 weeks for large orders, with premiums above spot reaching unprecedented levels. When buyers are willing to pay $35 to $40 over the quoted futures price just to get metal delivered within a month, that tells you the paper market has completely disconnected from physical reality. Have you noticed how quiet the major mining companies have been about this situation? There's a reason for that. Insider documents obtained from supply chain managers at 3 of the world's largest electronics manufacturers reveal a coordinated panic buying campaign that began in early December. These companies are securing their 2026 and 2027 production quotas right now, locking in physical metal at prices that would seem insane based on the old market dynamics. One purchasing manager at a major semiconductor fabrication company told colleagues in an internal memo that availability at any price is becoming the primary concern, not cost optimization. Let me walk you through what's happening on the ground right now, because this is where theory meets reality. A solar installation company in Arizona placed an order for 5,000 ounces of silver solder in October 2025 at $29 per ounce. Their supplier confirmed delivery within 3 weeks. That same company tried to reorder in early January at what they thought would be similar prices. The quote came back at $132 per ounce, with delivery estimated for late March and contingent on supply availability. The owner told me directly that he's now considering shutting down installation operations because he can't price projects accurately when his raw material costs triple in 8 weeks. This is the decoupling in action. While COMEX futures showed spot silver at $95 this morning, the actual price to acquire physical metal in commercial quantities is running $40 to $70 higher, depending on form and delivery timeline. That gap represents the market's admission that paper contracts mean nothing if you can't convert them into metal you can hold, ship, and use in manufacturing. According to the Silver Institute's latest quarterly report, total identified above-ground silver inventories available for industrial use have declined by 18% over the past 14 months. Exchange-traded funds backed by physical metal have seen withdrawals exceeding 200 million ounces as institutional investors move holdings into private vaults and allocated storage. The metal is disappearing from the visible market. But here's where Greenland becomes the key to understanding what happens next. Intelligence assessments from the Department of Defense, the supply chain task force, indicate that China has been conducting its own geological surveys in Greenland for the past 3 years, using research partnerships and academic exchanges as cover for resource mapping. Those assessments identified the same deposits that our USGS teams found. The difference is that Beijing started moving on securing access agreements with local Greenlandic mining companies 18 months before our White House memo appeared. Think about the strategic calculation from our government's perspective. You have the world's richest untapped silver deposits. Your primary geopolitical competitor has already started establishing commercial relationships to control access. And your entire technology, energy, and defense infrastructure depends on steady supplies of this exact material. What would you do? You'd make it very clear that resource sovereignty over those deposits is a national security priority, which is exactly what that White House memo accomplished. Mexico and Chile, our current primary suppliers, are watching the situation develop with increasing nervousness. Sources within the Mexican mining chamber report that government officials have begun discussing potential export restrictions on silver concentrates as a defensive measure against being cut out of a market where prices are likely to rise dramatically. If traditional suppliers start implementing export controls while the U.S. is simultaneously trying to secure Greenland's deposits, you're looking at a supply crisis that makes current shortages seem trivial. The Bank for International Settlements released data last month showing that commercial banks' net short position in precious metals derivatives reached its highest level in 6 years during the fourth quarter of 2025. Those banks were betting that they could maintain price suppression through paper contract manipulation. The Trump Greenland memo forced them to confront the reality that governments can override market mechanisms when national security is at stake. Those short positions are now massively underwater, and the covering process has barely begun. Here's what you need to understand about industrial demand. Advanced weapon systems being developed by our defense contractors use silver in radar arrays, missile guidance systems, and electronic warfare applications. A single F-35 fighter jet contains approximately 37 pounds of silver in its avionics and systems. The Navy's new destroyer class uses over 900 pounds per ship. We're not just talking about consumer electronics, we're talking about the physical materials that determine whether our military maintains technological superiority. According to projections from the Department of Energy, our domestic demand for silver and solar installations alone will require 420 million ounces annually by 2030 to meet renewable energy targets. That's half of current total global production, just for one application in one country. Add in electric vehicles, 5G infrastructure, medical devices, and defense systems, and you're looking at demand that cannot be satisfied by existing supply chains at any price that resembles historical norms. The physical premium explosion we're seeing right now isn't temporary volatility, it's the market repricing silver based on actual scarcity rather than paper contract illusions. When refineries can't keep up with fabrication demand, when electronics manufacturers are panic buying years of inventory, when governments are competing for control of the only major undeveloped deposits, the old pricing models don't just bend, they shatter completely, which is exactly what we're witnessing this week. Now, let me show you the mathematics that explain why $95 isn't the destination. It's just the first checkpoint on a much longer journey. Economic analysts at several independent research firms have been running models based on a scenario that seemed theoretical until last week. What happens if the United States decides to back a portion of its currency or debt obligations with strategic silver reserves instead of relying purely on the full faith and credit system we've used since abandoning the gold standard? The calculations are startling. Our current national debt stands at approximately $35 trillion. If our government decided to establish a strategic silver reserve representing even just 10% coverage of that debt obligation, we're talking about $3.5 trillion worth of silver. At $95 per ounce, that would require roughly 37 billion ounces. Here's the problem with that math. Total estimated global above-ground silver stocks, including everything in vaults, jewelry, industrial products, and investment holdings, amount to roughly 25 to 30 billion ounces, according to the CPM Group's comprehensive analysis. Think about what that means for a moment. To achieve even modest reserve coverage at current prices, we would need more silver than exists in refined form anywhere on the planet. The only way that equation balances is if the price rises dramatically to reduce the quantity needed. According to these mathematical models, a price range of $500 to $600 per ounce would allow a strategic reserve to provide meaningful backing for our debt obligations using physically obtainable quantities of metal. At $520 per ounce, 10% debt coverage would require approximately 6.7 billion ounces, a figure that becomes achievable when you factor in Greenland's deposits plus coordinated acquisition of existing stockpiles. You might be thinking this sounds like theoretical economics that will never translate into policy. But consider what we've already seen our government do when it decides something is strategically essential. The Strategic Petroleum Reserve wasn't created through gradual market evolution. It was established by legislation after the 1973 oil crisis, and our government directly intervened in commodity markets to build those stockpiles. We're looking at the potential for the same approach with silver, except this time, the industrial applications are even more critical to our technological future. According to sources familiar with discussions at the Treasury Department, preliminary conversations about a strategic silver reserve began in late 2024, well before the Greenland situation emerged in public discourse. Those discussions were initially dismissed as impractical because acquiring meaningful quantities at $28 to $32 per ounce would require such massive purchases that the buying itself would drive prices up dramatically. But at $95, the psychology changes. The market has already repriced. The shock has already occurred. Now the question becomes, does the government move aggressively to secure supply while the political window is open? Here's a scenario that illustrates where we're headed. Imagine you're running a mid-sized solar installation company in Nevada. Last year, you completed projects with an average profit margin of 18% based on predictable materials costs. Your silver solar inputs were running about $11,000 per major residential installation. This week, those same inputs are being quoted at $42,000, assuming you can even secure delivery. Your entire business model just became unviable unless you can pass those costs directly to customers, which means solar installations that were priced at $75,000 are now approaching $115,000. How many homeowners are going to proceed at that price point? This is the ripple effect hitting real businesses across our economy right now. But here's where the Greenland deposits become absolutely crucial to the long-term calculation. If those 12 billion ounces can be brought into production under American control, suddenly the mathematics of a strategic reserve shift from impossible to achievable. You're not trying to buy up existing global stocks and create shortages for industrial users. You're developing new supply, specifically designated for reserve purposes, while allowing existing production to serve commercial demand. This is why the White House memo matters so much. It's not just about acquiring territory. It's about securing the only deposit large enough to make a strategic reserve concept actually viable. The first domino has already fallen with silver breaking through $95. The second domino is the psychological barrier at $100 per ounce, a price level that seemed absurd to mainstream analysts just 2 weeks ago. Based on current momentum and the continued inability of paper markets to satisfy physical demand, most commodity strategists now expect that barrier to fall within days, not months. When silver trades with a 1 in front of it, the entire conversation changes for retail investors, pension funds, and institutional portfolios. It becomes a headline story instead of a niche commodity update. What happens at $150? According to supply chain analysis from major industrial consumers, that's the price point where companies begin seriously exploring substitution strategies, looking for alternative materials that can replace silver in some applications. But here's the reality that those engineers are discovering. For the most critical uses in solar cells, advanced electronics, and defense systems, there's no substitute that performs as well as silver. You can't replace the most electrically conductive element with something less conductive and expect the same results. Copper is cheaper, but 35% less conductive. Gold is more expensive and less effective for most industrial applications. Think about your own investment portfolio right now. How much of your savings is in stocks that depend on stable commodity prices and predictable supply chains? What happens to technology company valuations when their raw material costs triple or quadruple? What happens to renewable energy companies when the fundamental economics of solar panel production shift dramatically? These aren't hypothetical questions anymore. These are the adjustments that will flow through our entire economy as the silver situation continues to develop. According to equity analysts at Morgan Stanley, every $10 increase in sustained silver prices reduces earnings estimates for major solar manufacturers by approximately 12 to 15%, assuming they can't pass costs through to consumers. Let me walk you through what the next 6 months likely looks like based on current trajectory. At $120, we'll see the first wave of industrial users announcing force majeure on contracts because they physically cannot source material to fulfill orders. At $160, smaller fabricators and manufacturers will begin shutting down operations entirely, unable to compete for scarce supply against larger competitors with deeper pockets. At $220, governments beyond the U.S. will start implementing export restrictions and strategic stockpiling programs, accelerating the shortage. Each of these milestones creates its own momentum, pushing prices higher. Let me be direct with you about the timeline we're looking at. The $95 breakthrough happened in pre-market before most people even woke up this morning. The physical premium, reaching $130 or higher, represents what's already happening in the real world of commercial transactions. The U.S. Mint pricing domestic silver at $173 is an official acknowledgement that government entities are competing for the same scarce supply as private industry. These aren't future projections. This is the current state of the market right now. According to commodity traders I've spoken with, who have decades of experience in precious metals markets, we're now in what they call price discovery mode. That's the phase where traditional technical analysis and historical price patterns become irrelevant because the fundamental structure of the market has changed. The paper contract system that suppressed prices for years is breaking down. The physical shortage that was theoretical is now undeniable. And governments are signaling they're willing to use national security powers to secure supply. One veteran trader told me flatly, "I've traded silver for 32 years, and everything I knew about this market stopped being relevant on January 14th. If you're waiting for a dip back to $30 or $40 to buy silver at what you consider a reasonable price, you're making a critical strategic error. You're assuming this is a normal commodity cycle where high prices bring on new supply and eventually push prices back down. But this isn't a normal cycle. This is a resource war where governments have decided that control of silver deposits is worth geopolitical confrontation. Think about oil in the 1970s. Once strategic competition entered the equation, prices never returned to pre-crisis levels, even when supply expanded, because the market permanently repriced based on geopolitical risk. The Bank of America released a commodity forecast revision this morning that increased their 12-month silver price target from $42 to $165, citing fundamental shifts in supply-demand dynamics and sovereign competition for strategic materials. When major financial institutions are revising their forecasts by nearly 300% in a single report, that tells you the old models are completely inadequate for current reality. Goldman Sachs followed within hours with their own revision to $148. And JP Morgan is rumored to be preparing a report that could go even higher. Here's what you need to understand about the classification change that's happening. When silver trades as a commodity, its price is determined by industrial supply and demand, investment flows, and speculative positioning. But when silver becomes officially classified as a strategic national asset, as the White House memo strongly suggested, the pricing mechanism changes entirely. Governments don't care about quarterly earnings or return on investment in the normal sense. They care about securing supply, regardless of cost, because the alternative, losing access to critical materials, is unacceptable. According to defense industry analysts, the reclassification of silver as strategic has implications that extend far beyond just price. It means export controls become likely. It means domestic production gets preferential treatment and possibly subsidies. It means that international supply chains that we've relied on for decades could be disrupted by policy decisions made in Washington rather than by market forces. Japan learned this lesson with rare earth elements when China restricted exports in 2010. Prices for some rare earths increased by over 1,000% in 18 months. We're looking at a similar dynamic with silver, except the applications are even more widespread across our economy. Think about what $500 silver means in practical terms for you. If you bought 100 ounces at $30, you invested $3,000. At $500, that position is worth $50,000. But more importantly, you've preserved your purchasing power in a world where the dollar's value relative to strategic materials has decreased dramatically. That's not speculation. That's the mathematical outcome of scarcity meeting government intervention. Now consider that the U.S. Mint is already effectively pricing silver at $173 for domestic transactions. The market is telling you right now, today, that the real clearing price for physical metal you can actually acquire is already well north of $150. The $95 spot price is just the lagging indicator catching up to reality. The final warning I need to give you is this. The window for acquiring physical silver at anything resembling historical prices has closed. The $95 price you're seeing on screens today is not the top. It's not a bubble about to burst. It's the market's first honest attempt to price silver based on actual scarcity and geopolitical competition rather than paper contract manipulation. When the U.S. Mint is already pricing domestic metal at $173, that tells you where the real clearing price sits right now for physical delivery. We started this discussion by asking you to forget the price on the screen and focus on the deeper reality. That reality is now undeniable. The resource war has begun. Greenland's deposits are the prize, and silver has been reclassified from a commodity you trade for profit into ammunition for industrial and technological supremacy. The time for illusions is indeed up. Your move now is simple. Understand that we've crossed a threshold where the old rules no longer apply. Whether you choose to hold physical metal, invest in mining companies with access to undeveloped deposits, or simply adjust your portfolio to account for a world where strategic materials trade at dramatically higher prices. The key is recognizing that we're not going back to $30 silver. That world ended when the White House sent that memo. The new world is just beginning to emerge, and $95 is only the first stop on a journey that the mathematics suggest ends somewhere north of $500 per ounce. The question isn't whether silver reaches those levels. The question is how quickly we get there and whether you positioned yourself before or after the crowd realized what was happening. Based on what we've seen this week, that realization is happening right now.